There he goes. He's all set. That's all we needed was that.
That's all we needed. The open today, folks, is that this is the Rebel's Edge. Mm-hmm. He is Pete Najarian. I'm John Najarian, and we're about to come back to you with some really interesting takes on the market, consumer confidence, and, of course, what is going on with Bitcoin. All that and more on today's Rebel's Edge. Bam. You get a double.
That's the only way to start the show. I mean, you got to do that.
You get a double today, folks. Again, welcome to the Rebel's Edge. He is Pete Najarian. I'm John Najarian. And we're going to be breaking down a lot of those stories that we just detailed. And as always, we start off with the macro minute. And gosh, Pete, what would it be today? Consumer confidence or the fact that hedge funds are rapidly pulling out of tech stocks and media stocks because of some of the things perhaps that Microsoft was talking about at the end of last week that kind of panicked folks. It wasn't just Walmart, it was Microsoft as well. What are you looking at for macro, Pete?
I'm going to take what you just said in there, one of the two, and I'm going to go with consumer confidence. And we never talk about this ahead of time, which makes it much more fun. So yeah, consumer confidence, John. I mean, you want to talk about getting hit and getting hit hard. Holy smokes. And the conversation really kind of moves over towards the Trump tariffs and how is that going to whole thing work? And is inflation going to start moving back up again and then get everybody sort of spooked? I think that's the biggest concern right now. And that's why it's so macro, but it is right where we are right now. And it's why the markets have been kind of all over the place and a lot of volatility within the markets.
Yeah, well, on a daily basis, Pete, we're seeing some pretty heavy turnover, in particular of NASDAQ names, just like you said. Yeah. We were down over 300 points in the NASDAQ today. We came back some. I'm not going to say came roaring back, but we came back some, and we're down like 250 at mid-session. But the catalyst, Pete, seems to be that we've seen a lot of people talking about the strength of the consumer, everybody from Domino's to Walmart, and then because of the moves that Microsoft has been making, maybe even Microsoft in there. So your consumer confidence number, yeah, it's not surprising that with these headlines dominating, consumers are not quite as confident. Let's dive into fantastic futures. I could talk about the 10-year at 4.3, Pete, but instead I'm going to say Bitcoin falling from that trading range of maybe 94 to 99,000 per Bitcoin has broken down dramatically, broke down through 88,000 per Bitcoin, taking Ethereum, Solana, and virtually every crypto down with it. So that is my fantastic future, Pete.
And I'll just jump on that for a second too, John. The fact that we got all the way down to 86,000, it's down 8% early on. I mean, it absolutely has been getting crushed. And this is as bad as I have seen it look. And by the way, I took a look back and I saw, as Trump got into the election and all of a sudden it turns out that he did win and he's the president. We had this big turn. We were at 66,000, got all the way up to call it 86,000. Well, that's where we sit right now, John. So we have pulled all the way back to that level just after the election where we were at 86,000. So it's been a little while. It's been a couple of months, but very interesting to see that. And of course, you and I can't go through a fantastic future without hitting the volatility index. You hit it the other day with Charles Payne. You were exactly right on everything. I mean, we've been seeing buying, right? Huge numbers of buying in the volatility index options. Well, they're starting to reap some of the rewards today, John, because they got all the way up to 2138 in terms of that volatility index. Let's call it between 19 and 2150. That's pretty major. I mean, we've made a very, very rapid move from call it 15 to 20 plus in a very short period of time. And that's how volatility goes a lot of the time. It really makes big spikes. It also can pull back very rapidly. I think this one still might have a little legs in it.
It sure might, Pete. I mean, as you say, we've got to take profits quickly when we get these moves. And for those of you who did not take it this morning when we hit that high, like Pete said, roughly 2150, 2148, If you didn't start taking some of that off, then you're hoping for a disaster in the market that sends volatility higher. Now, we could get it, Pete, but just as I said last week, we are likely to see some bigger pull this week, which we now have seen. And I think a lot of times these aren't earnings out of the VIX. This isn't a new product introduction. It's not any of the news that would normally be something that would play out over days, weeks, months with a stock. Instead, it's just basically fear or not fear. It's greed or not greed that goes on with this. And when we see it doing what it's doing right now, well, a lot of people get spooked. And buying into the VIX at 21 is probably not the smart move at this point, Pete.
Right.
All right, let's dive into Zoom. Weak growth here. So they are yet another equity that is talking about, hey, consumer churn. That's the changing story at Zoom's growth. In other words, churn, where you get one guy in and you lose one, Pete. When you're seeing that and it's just a churn, you're not really adding, like, for instance, Netflix talks about churn, but they've been steadily adding. Disney talks about churn, but they've been steadily adding. Not so much over at Zoom, ZM, and that's why this one's just getting cracked again, Pete.
Yeah, they're getting crushed pretty hard right now, John. I think it's kind of interesting though, because when you look at this, I really like certain things when we're looking through and going through these earnings numbers and so forth. Up 6% year over year as far as the revenue growth. Yes, I understand for the quarter it's up 3%, but I like that year over year. I like to see where are you now versus where you were, and I think this is an opportunity potentially starting to get out there for us, because let's be honest, this is the leader in communication, right? I mean, video communication, it's Zoom. It's just like Kleenex. We call it Zoom no matter what we're using. So I think it's something to keep an eye on. I'm looking at the PE at about a 14 right now, John. They've got an absolutely phenomenal balance sheet in front of us. So anything that comes out that looks positive at all for me would definitely have me turn my head for Zoom. I don't need to jump in there now, but I certainly put it on the radar in case we start to see things start to change just a little bit. And we all know that this thing's got a lot of different legs to it. They've got customers that are weakening maybe to some degree. It's something that I think we should definitely keep an eye on, though, because I think they are the king, and I think they will bounce back.
Well, they're right smack dab in the middle, Pete, at 73 or 74. That's basically, from 94 on the highs to 55 on the lows. 75 seems to be right in the middle. So a lot of people are apparently betting, just as you said, that maybe if it stabilizes here, they can be buyers. All right, DigitalOcean, DOCN. This is a cloud play. So when we're seeing this one, shares not doing what Zoom is doing, Pete, doing just the opposite, just jumping to the upside. DOCN, DigitalOcean, they had a lot of positive things to say. It was up as much as 20%. At that point, Pete, it was $45 a share. That's where it opened. It's faded from there, but it's still at 41.59. That's still a 12% rally. So people like what they heard and saw from DigitalOcean today.
Yeah, I think DigitalOcean actually did a very nice job, John. They talked about a lot of different things, but when you've got growth year over year of 37%, I would say that's reason enough that you might get pretty excited about things. The high-end consumer is where they were focused. So they were looking at that high-end consumer. They talked about the fact that it represents about 20 some odd percent of what they put out there. But of that 22%, 37% year over year. That's some pretty nice growth. I like what we see out of this one. Again, they do have some high shorts, John, which is, I think, part of the reason why it did get up to 20 or 21% move to the upside. And yes, it has eased back, probably getting eased back because of what's going on in the rest of the market, specifically the NASDAQ. But I like this name. I like what we're seeing here. And by the way, again, I keep looking at some of these stocks, John. You remember we always used to talk about, well, these PEs are pretty high here and they're pretty high there. This is not one of those. Their PE is a 20. To me, that's not all that expensive. And I think with any kind of growth, there's a good reason why this thing was up 20%. And I wouldn't be surprised if we are a little bit more positive in tomorrow's market, we might see a name like this start to creep back up there again, closer to the highs of today.
Well, let's dive into a little Sempra Energy, Pete. Symbol SRE, down hard. Well, what do? They're a utility, basically natural gas as well as electricity in California and Texas, at least, perhaps in some other areas too, Pete, but it's their outlook for earnings next year that were well below Wall Street estimates. In other words, it's not just how did you do this quarter, it's going forward. The stock is looking like it's a little overvalued. If the street was looking for $5.25 a share, and they're saying, hey, maybe something like $4.70 to $4.90 a share. That's a big miss from a $5.25.
That's a you know what's going to happen sort of a moment, right? If you're the CEO or the CFO and you're out there and you're talking about this thing and you put out that forecast, you know exactly what people are going to do. Those palms are out, John. That's exactly what we were seeing in this particular name today. It was down pretty considerate, 20%? Something like that. I know it was pretty big. And the PE is still sitting at a 17. That's what these guys are, though. When you look at these kind of names in the energy space, you're not seeing usually the very inflated numbers. But I think the thing that really stands out for me most is the fact that they were commenting on the fact that this year it was a milder winter. And because of that, they talked about some of the numbers, and that's why their outlook is what it is. It's why the numbers this quarter didn't look all that impressive either. So I think for those reasons, John, this is one of those names. I'm not all that thrilled with it. I don't think that it's a name that I need to chase. I see the sell-off. It makes sense to me, and I don't know that I need to keep putting this one on the watch list. As a matter of fact, I'm going to have to wait a quarter or two to see if they can turn this thing around.
Well, we might have a disagreement here, Pete. I'm not saying I'm buying it here. Yeah. I know it bounced off of 65, and that was a new 52-week low, 65. We came back up, and right now we're at about 70, roughly. Again, a pretty far cry from 95, which is the 52-week high. But I do think, just as you said, that when you miss this badly on guidance, everybody redoes their numbers. And they say, okay, plugging in these new numbers, we think instead of a PE of this, it should be trading here. And based on that, it's going to see a 20% haircut today. I get it. But I also get the idea that energy is something that we're all going to need more of. And any big infrastructure energy player on significant drops like this, I'm a little interested. Now, granted, I wish I would have pulled the trigger at 65, Pete, rather than 70. So I'm going to be patient like you, because there are no one-day events in individual stocks. In the market, yes, because of rotation, one sector to another, but not in individual stocks. So I'm going to see if we don't test back down to that 65 level again before I get my pen out and start writing. All right, hymns. Wow. These guys, of course, telemedicine, if you want to call it that. That's what they call themselves, Pete, basically telemedicine. They were, among other things, they were delivering things like minoxidil or derivatives thereof for baldness cures in quotes, because it didn't work for me. Also, erectile dysfunction, and of course, GLP-1 drugs, Pete, all the Mounjaro, the Ozempic, the Zep, all of that stuff. What they were doing, Pete, was mixing their own mixture of those, a little bit of this, a little bit of that. And the issue isn't whether or not that was dangerous. The FDA gave them permission to do it. But when those drugs were hard to get, they're not hard to get anymore. They're plentiful now. Novo Nordisk and the makers like Lilly and so forth have basically made a ton of it because this is the most popular thing on the planet. So now they can't just get around the rules by making their own mixture. So the stock was off 15%, 20%. Last I looked, Pete, it was out 28% today.
Yeah, I saw that as well, John. That was pretty brutal. But it makes a lot of sense, because if that's where you're making all your money and now all of a sudden, hey, the competition is on. In 1 week, this stock has dropped from $68 a share to $37 a share. I would say that's definitely not so good. And it's been getting clocked for a while now. And as those drugs and the shortage has been replaced now, and all of a sudden that's all resolved, everybody can keep up with this whole thing. Yeah, it just shows you supply and demand. That's exactly, this is a textbook version of that. And all of a sudden, the supply is there. So the prices come down. That's what they're seeing right now at HIMSS, and it's going to be a problem because that was the main catalyst for this stock to be making the move that it made to the upside. So it's also the main catalyst that's going to pull it to the downside, John. This one, I think it's always worth watching a name like this just because of the diversity of what they've got. But that's the major part of what was working for them. And with that not working for them into the future, that could be a bit of a problem. At some point, it'll be oversold, but I don't think it's there yet.
All right. I'm right there with you. Let's take a look, Pete, at some of the combine things and the NFL, if you will, and see what you want to talk about here with Goodell.
Yeah, I think Roger Goodell, I mean, the combine's going to be phenomenal. By the way, the combine's probably going to have ratings higher than just about every NBA game. Let's be honest. Definitely more than the NHL and blah, 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 blah. So we go on and on about that, but it's all true. And that's what the NFL is. We talked about the fact that, hey, look, the salary cap just went up $22 million, $53 million in 2 years. These are all the numbers because of the fact that the NFL is what they are. There's a problem out there, though, John, with the NFL. And here's where the problem really starts. I think that Goodell has got to get together with the owners and make some changes in what they're doing. Now, every year they always get together. They always come back with something. You know what they came back with this year? It was that kickoff, the kickoff from the USFL, right? I mean, that was sort of interesting, but it's something that most of us didn't like. Most of us don't understand. Most of us think it's the most boring play of the game. So why would they continue to keep this going? I know it's for health reasons. Change how you do it. Maybe they have to tweak it, John, I think in a big way, not just a little way. They need to tweak this thing. If it's because players are running downfield, hey, they run downfield for a long period of time on punts because most of these punters can kick the ball 55, 60 yards in the air. If you're able to do that, John, these guys are running a long distance before the major collisions go. So they've got to move things around and do it and make it a little bit more palatable, in my opinion. I think that the other thing would be the tush push. We got to get rid of this. You remember forever, John, it was one of those things where, hey, you cannot help one of your own players get to the next level, right? Well, all of a sudden it's okay. And these guys are totally fine with it. I think it's a BS kind of a play. I don't like it at all. I know. And think about the potential injuries there. I mean, everybody knows exactly what's going on when they get into position for the tush push. And all of a sudden, we saw it during the Super Bowl, as a matter of fact, some guys walking out of there with some sore necks. Well, why is that? That seems like an injury problem to me when you're absolutely going after them with all these big, huge monsters trying to push people forward and push your quarterback into the end zone. I think the last one would be this. When is the NFL going to pull their head out of their you-know-what and figure out that, A, every team should always have 3 quarterbacks suited up and ready to play? Why do we always have to have, well, this guy's going to be off to the side and the practice squad's off to the side? I think they need to have 3 quarterbacks live for every single game. And I don't understand why. I don't think that the practice squad guys have to play during the game. But if there are injuries, I think they should be able to play during the game. So why not put them in uniform? I don't understand that. So those are my 3 fixes, because I think this kickoff thing, John, really could at some point be something that could blow up a little bit, at least on some of the ratings that they get on TV, because people are absolutely bored to death with that whole thing.
Yep. First one you named, the kickoff, absolutely do away with that stupid thing. Second thing, the punt, that is where the guys are full speed. Literally, except for those 2, what do they call them, Pete?
Gunners?
The guys, what's that?
Gunner?
Oh, the gunners, yeah. Except for the gunners that are lined up and they have a defender against them, sometimes 2. Everybody else is just a free ride downfield, full speed. So, I mean, those collisions are ugly. Second thing that you were talking about, Pete, I think the tush push is stupid. Yep. And you're going to see a quarterback or 2 get hurt too. It's not just going to be defensive linemen. It's going to be quarterbacks. And when that happens, that's when Goodell finally pull his head out, Pete. Because like you say, I mean, Bart Starr didn't need the tush push to get across versus Dallas in that first Super Bowl. And I don't like the idea of this one either. So I agree with both of those. I told you I'd have some NFL things, Pete, for you. My sunglasses. Some NFL things for you. There's an interesting thing. The top 4 linebackers coming into the combine, Pete, I looked at this and I said, okay, who are they? Well, basically, Demetrius Knight, South Carolina, Jihad Campbell, I love the name, from Alabama, Carson Schwinsinger from UCLA, and Jalen Walker, Georgia. These are all great players, but you know what they are, Pete? Strong safeties.
Right.
They're not linebackers. I know they play linebackers, and I'm not trying to denigrate their abilities, but if you put these guys up against Saquon Barkley and some of these great running backs, they will get run over.
Yep.
Because they're not big enough. At 6'2" and their size, Pete, they are not big enough. They're fast.
Yep.
They're going to put up some impressive numbers at the combine, but they're not going to be able to stop somebody. They're not going to be able to get in front of a guard unless they play 50 Matador or whatever, Pete, where it's like, ole! And you jump to the side. That guard is going to just pound these guys when he's pulling around the corner and that linebacker's coming out there to make the tackle. Ain't happening.
Right.
The guy might be fast enough to cheat and try to cut off that guard's backside and get the guy from behind. But if that doesn't work, you're looking at, 20, 30-yard downfield run. And now Saquon is going against a defensive back, which is what all these guys are. They're modified defensive backs playing linebacker. Look at their heights and weights, folks. They're all of them 6'2", and none of them are over 225 pounds, Pete.
Right. No, it's a real problem. And that's where these GMs, I think, are fools. They're fools because they pay too much money for receivers when there's so much depth in receiver. You know where we've got a lot of depth this year? Running back. These running backs, many of them are pretty damn big, John. They're bigger than a lot of these linebackers. They might weigh 230 pounds or more, and they're going to run over these guys. Like you said, they're basically strong safeties. That's been a mistake for a while, and that's another reason why I think the coach of Detroit is brilliant, because a couple of years ago, I think it's 2 years ago now, Jack Campbell, linebacker out of Iowa. Johnny's 6'5", 255 pounds. He's a linebacker. He plays linebacker. And oh, by the way, he runs close to a 4.6 anyway. So if you've got the speed and you've got the size, you've got yourself a piece for stopping the running game. But you know what? Not very many GMs are smart enough to figure that out. So that's why Saquon Barkley ran for over 2,000 yards. It's why Derrick Henry, who's a monster, can run for 2,000 yards. And there will be more running backs coming into the NFL that have got the size to be able to run over these guys that are playing linebacker, but they're really safety. So I agree with you. I'll jump on this one next week. I got one more for you.
All right.
Major League Baseball. So last year, the Mets, $317 million on the payroll. You know who's behind them? The Yankees, $308 million on the payroll. You know who's behind them? The Los Angeles Dodgers, $266 million. This year, they flipped it a little bit because now Los Angeles just keeps on signing guys, John. I don't know how long they're going to be able to do this, but $321 million on their payroll. The Mets are $315, Phillies $279, and New York Yankees are $277. So a lot of money going into there. You know who was in the playoffs last year? Most of those teams. You know who else was there? Cleveland, Kansas City, Baltimore. 105 million, 122 million, and 109 million. How's the return on investment for those guys? I'm telling you, John, money doesn't always matter. And you and I are money guys. But in this case, it doesn't always matter, because just take a look in baseball, how often you're going to see some of the highest paid, yeah, they're going to be there. And some of the lowest paid, they've got the right guys, they've got the right coaching, they got it all done, and they get to the playoffs too, and they make a deep run. So I think it's pretty interesting to see when you've got $200 million more for those guys. I don't know. I think some of these guys have figured it out in a much better way than the guys that have all the money in their pockets in New York.
Well, of course, I'm going to agree with that, Pete. But I will say, Major League Baseball, MLB, is one of the only of the big sports, one of the only ones that does not share revenue. Mm-hmm. Now, if you're on the Sunday night baseball game on ESPN, yeah, they share revenue for that game. But if you're the Yankees and you have the Yes Network, if you're the Dodgers and you have your own network and so forth, how do the Minnesota Twins compete with that?
Yeah.
How does the Cincinnati Reds, which I know one of the owners very well, how do they compete? And the answer is they got to be willing to lose money because they can't. Without the shared revenue from TV, you're going to have the haves and the have-nots. And every once in a while, with Moneyball kinds of creativity, you will see a team like Oakland, which was, of course, the Moneyball team. Now they're Las Vegas. But you'll see a team like that can win. But you're not going to see them win repeatedly. You're going to see them put together a season. Everybody figures out, oh, what did these guys do? What did Theo Epstein do? What did this general manager do? And then it's the edge goes away for something like a Moneyball type thing. And meanwhile, you've got an extra $75 million a year in your pocket. Maybe it's more that those guys don't have. That's not fair. It's not right. Sooner or later, baseball will have to address it, or they will go bye-bye.
Yep. I agree. I totally agree. Yep.
Well, don't you go bye-bye, folks. Pete and I will be on, we'll be on News Nation at about what, Pete? Is it 5:30 tonight Eastern?
About 6 o'clock Eastern, or 5:50 Eastern time. Yeah, I think we go on.
5:50 Eastern time. Join us then, because we love these guys, and Connell is a great host over there, so we're looking forward to it. And tell a friend about the show. Make sure you join us tomorrow at 1 p.m. Eastern time for the Rebel's Edge. See you then.
See ya.